Hello, everyone, and welcome to an all-new episode of OIC's Wide World of Options. I'm your host, Mark Benzaquen, and I'm so excited to welcome my next guest, Tony Zhang, Chief Strategist of OptionsPlay and frequent on-air contributor to CNBC. Tony, welcome to the show. Thanks so much for joining us today. Really appreciate it.
Thank you so much for having me. We're here in beautiful Palm Beach Gardens at the OCC conference.
Yeah,
Really
absolutely. Absolutely gorgeous. Another great event. I'm sure it's going to be today. Everything is going to be kicking off. But what we're here to do is we're going to talk about the OIC webinar program. So it's a monthly webinar program that we do 2 episodes each month. This coming month, we're going to be talking about some more intermediate and advanced spreads. We're going to be talking about calendars and diagonals. So I'm going to pick your brain, see what you have to say about it. When it comes to spreads, there's typically 3 kinds, as you know, traditionally. Verticals, we've got calendars, and then a combination of the 2, diagonals. Verticals really looks to take advantage of price appreciation, stock price changes, any changes in the underlying. Calendars is a little bit more taking advantage of implied volatility levels, and then diagonals is kind of a little bit of both. But that being said, with calendars, when you are doing your presentations, when you are educating your followers, and you're talking about calendars, how do you approach it? What is it? How do you explain the purpose of calendars, how they work, et cetera? What are your thoughts on it?
Yeah, I'm really glad that you're bringing up the progression from vertical spreads to calendars and diagonals, because whenever we talk about complex strategies like this, we always try to first break it down to its basic fundamentals, because ultimately all complex option strategies are made up of just single leg long calls and long puts.
Right.
It's important to understand those foundational concepts before you move on to vertical spreads, calendars, and diagonals, because those foundational elements are critical in understanding these types of more complex strategies. So
Right.
just at a very, very brief overview, when we think about these vertical spreads and calendars and diagonals, ultimately they're just a combination of long calls, long puts, short calls, and short puts. And long calls and long puts themselves have some advantages and some disadvantages, and short calls and short puts have some advantages and disadvantages. And whenever we're trading verticals, calendars, and diagonals, what we're really trying to do is kind of get the best of both worlds, right? We're trying to get some element of the long, basically what is long convexity with the long calls and puts, and at the same time getting some advantages of being short options with the premium collection that you're getting. So if we're talking about calendars first, calendars is a direct combination of being long and short, the call and put. And what's unique about the calendars is that it is quite different from the vertical spread, whereas opposed to the diagonal is closer in nature to a vertical spread, much more closer to a debit spread than the calendar. The calendar is actually, when I teach it, I think of it as a similar trade structure as a short straddle. It's actually a short straddle with limited risk, because you have a very similar risk profile as a short straddle. If you look at a P&L chart of a calendar spread, you can mistake it sometimes as a short straddle, but you actually have limited risk, and you use it in a very similar fashion or outlook as a short straddle. When you have a expectation that implied volatility will come in the short run, you're expecting implied volatility to decrease, and usually that happens with earnings, right? So you trade them right before earnings with the expectation that implied volatility will come in after the earnings announcement, and it's also a neutral strategy as well at the same time. So you're basically trading in whenever you think that an earnings event is not necessarily going to make a big move in one way or the other, and at the same time you're expecting that implied volatility to come lower. That is a good time to be trading a calendar spread.
I like how you compare that, and frankly, I never even crossed my mind, but comparing it to a short straddle, because you're right, the P&L chart does resemble a short straddle, so it's an excellent way to approach it. For people that are listening that are just getting into options, what exactly is a calendar spread? So how would you set that up for them?
Yeah, so you can trade a calendar spread either as a call calendar spread or a put calendar spread, and they're very similar in nature, but effectively what you're doing is you're buying a long-dated call option and then selling a short-dated call option at a expiration date that's shorter than the long-dated expiration at the same strike price. So, for example, if you have a $100 stock, you're buying, let's say, a $100 call option that expires, let's say, 60 days from now, and then you're selling, let's say, a call option that's 30 days from now at the same strike price. So you basically buy the 100 call that's 60 days out and sell, let's say, a 30-day call option at the same strike price at a $100 strike price. And if you look at the P&L chart of that, that looks very similar to a short straddle, but it has limited risk. And that's kind of why I think that it's almost like a beginner version of a short straddle, because it gives you many of the advantages or a similar payoff graph as a short straddle, but you have limited risk, which is, I think, the thing that scares most people about a short straddle is number one, the unlimited risk nature of a short straddle, but also just the relatively high margin requirements that you need to sell a short straddle. So this basically gives you the advantage of that with limited risk and also substantially less margin required to execute the trade.
Yeah, excellent point. So if we sell in your setup, stock's $100, we sell a 30-day at the money call, we buy a, say, 60-day at the money call. What are we looking to happen to the underlying? What are we looking to happen to implied volatility, for example, in that first 30 days that we're short that option?
Yeah, so if you look at the P&L graph of a calendar spread, you have effectively break-even prices that straddle that $100. So let's say the break-even price is between 95 and 105. What you're really looking for is for the underlying to stay within that trading range between that 95 and 105. And at the same time, you benefit from the implied volatility of the shorter dated option coming in faster than the long dated option, because you're effectively short implied volatility with the short option and you're long implied volatility with the long option. And you're expecting that differential to come in, but where the short option loses more in implied volatility than the long option loses, and so you gain on both the time decay, which is on the short option, is faster than you're losing on the long option, and you're also gaining on vega, which is the sensitivity of the option to changes in implied volatility.
Right. So comparing it to a short straddle again, I like to talk about straddles as event trading. You're trading them for a specific event. You had mentioned earnings, for example. With a calendar, if an investor were to trade a calendar, selling that front dated and buying the longer dated, is that, do they trade those around earnings? And if so, is it kind of similar to a straddle that once the event occurs, then maybe the trade gets closed out? Is that how those work?
I would say most commonly that is where people trade calendars most often, is around earnings, because that's really where you have the most discrete volatility crush, right? Where you have the most consistent volatility crush, which is where implied volatility comes in due to a catalyst event like earnings. You obviously have macroeconomic events that cause that as well. So, for example, if unemployment number comes out, you might, any type of big economic number, FOMC meeting, that type of stuff, where there's a lot of uncertainty going into the event that you're expecting. Once the news comes out that implied volatility will come in, those are other times that you could potentially sell or trade a calendar or short a straddle. But I would say it's far more common for traders to use it around earnings.
Around earnings, yeah, certainly. Let's go to the next step. So we talked a little bit about verticals. We talked a good deal about calendars. The combination of the two is the diagonal.
Yeah.
So how do you approach that? So again, you're giving a presentation. What are the points that you are sure to hammer home when it comes to diagonals?
Yeah, so when we think about diagonals, we always make the progression from a long call. Right? We start with a long call because that is the predominantly a long call or a long put, because that's the primary driver of a debit vertical spread and the primary driver of a diagonal spread. And what you're doing is when you're trading the vertical, what you're doing is you're selling a let's say in the example of a stock trading at 100, let's say you buy a $100 call option. You're buying that call option because you believe that stock will rise in the future. But the cost of that call option many times is prohibitive, meaning let's say you pay $5 for that call option, you need the stock to get above 105 just to break even,
Right.
which means that you have to believe the stock will be meaningfully above 105 to justify buying that call option. And it's not every single day that you expect the stock is going to make a 10% jump in the time frame that you're buying that call option. So that's why we turn to vertical spreads, because what you're doing is, let's say you're buying the $100 call option, you selling a 110 call against it at the same expiration date, because by selling that 110 call option, you're collecting a little bit of premium. That's going to offset the cost of that option that you're purchasing. It's going to reduce the risk. It's going to reduce the amount of capital that's required to put on the trade.
Lower your break even.
And it's going to lower the break even price. And what you're doing, and the tricky part about the vertical spread is choosing that upper strike price, that 110 strike price. You have to choose a strike price that brings in enough premium, but also doesn't necessarily cap your upside potential, right? So it's a bit of an art in selecting your upper strike. So that's a reason that we trade debit spreads, is to try to reduce cost, reduce risk, and improve your break even. And what you're doing in a diagonal spread is you're taking that exact same concept and putting it a little bit on steroids. What you're doing is you're selling a shorter date. You're doing the same trade, but you're doing the short option. You're doing in a shorter dated expiration date. And the key there is because what you're trying to do is take advantage of a little bit higher time decay on the shorter dated option versus selling that 110 call option at the same expiration date, because the idea is that shorter dated options have a higher time decay or faster time decay for every day you hold on to it. So you're basically collecting a little bit more premium on the short option than you are on the long call option. So the diagonal spread is really a more advanced version of a vertical spread, but you're having the same advantages, but it actually is adding quite a bit of complexity to it, because you now have two expirations to manage, and you have to manage the trade at the first expiration, what do you do at the first expiration, whether or not you want to hold on to it, and what do you do as you approach the second expiration. So it adds a little bit more complexity, but what you're doing is you're basically getting faster time decay. You're reducing your potentially your overall cost of that long call option by more than if you just were to trade a debit spread.
And I like how you say that it's like a vertical on steroids. One of the things that I like to talk about when we talk about complex spreads is the more moving parts there are, the more difficult it is to manage. I compare it from a bicycle to, say, a motorcycle. If something's wrong with my bicycle, I know it's the chain or it's a flat tire. But if something's wrong with the motorcycle, it could be any number of things. So the more moving parts there are, the more difficult it is to diagnose and manage. With a diagonal spread, even though you only have the two legs, you've got the two different expirations. So to me, it's more difficult to manage, more complex than a standard vertical. So if things go wrong with the diagonal, what do you do? What are some possibilities to manage that position if things go sideways?
Yeah, well, I mean, here's the thing, is that there's actually quite a few different ways the diagonal spread can go wrong, right? So let's first talk, before we even jump into that, one thing I do think it's important to mention is that when you think about a diagonal spread as a variation on a debit spread, is that debit spreads, you're never going to pay more than the width of the debit spread, right? But by the nature of how options work. But when you're trading a diagonal spread, there are times where the net debit of the diagonal spread actually is greater than the width of the strike. Now, to kind of address your question with regards to if the trade goes wrong, I usually always like to manage my diagonal spreads before the first expiration. Things get a little dicey once you get past the first expiration, meaning, I always tell clients that when you're trading options, your exit strategy should be fairly black and white. There shouldn't be a lot of what if this, what if that, it depends on this, it depends on that, in terms of your stop loss strategy.
Right. We talk a lot about getting out of the trade, or planning to get out of the trade is equally as important, if not even more important, than when to get in. So having that understanding of what you're willing to risk, what you're willing to bear in terms of losses.
Yeah, and if you think about like what's different between a retail trader and a professional trader, the difference between it is the professional trader has very strict rules around risk management, right? And that's the one discipline that retail traders, generally speaking, aren't forced to have. And that's really why I always teach, whenever you're trading options, the first thing you should think about is how much are you willing to lose, and making sure you stick to that, right? So, and again, like I said, it should be very black and white in terms of when you cut your losses on a debit trade structure. There are different types of rules for credit type trades, but they're still also black and white. Now, when the trade goes in your favor, that's really where you have quite a few different options. And that's, I think, is more of an art than a science, versus when the trade goes against you, it should be very clear cut. This is my stop loss level. This is where I cut my losses. And there should be no, there shouldn't actually be a lot of thought into whether or not I should cut losses. It should be very black and white, and you should actually spend far less time focused on your losers than your winners. You should really be focusing your time on, okay, I have a winning trade. The market clearly has clearly affirmed my overall view in the markets, or my view on this particular stock. Let me focus my attention on how do I turn this small win potentially into a much larger win by rolling my options or adjusting my options. And the trades that are going south, those are the ones where the market is saying, hey, you're wrong. Cut those out and move on.
Right, cut the losses and move on to the next trade. Yeah, I like that idea. Again, we talk about planning out your trade, which is not only when to get in, but when to get out. And once you hit those markers that you've set up for yourself, just call it a day and be done with it. So I like your point of, you shouldn't focus on your losers too much, because you already know, once I lose X percentage, whatever that percentage may be, that now I'm out of it and I'm on to the next one. So it's almost, as you had said,
methodical.
It's very black and white, right? Once I hit that, I'm done. The winners, which I think, again, I like your point, because I think people spend less time thinking about their winners. And hey, I bought a call, the stock's going up, things are going terrific, but they're not thinking about how can I make things even more terrific.
Exactly. So when I talk to most retail traders, they do the exact opposite. Right?
Yeah.
They spend all their time focused on their losers. So that's why I get far more questions from investors asking, hey, I have this losing trade. What can I do to fix it? Versus I rarely get a question saying, hey, I've got this winning trade. What can I do to make it a bigger
Even
win,
better,
right?
yeah.
But really, the reality is that, the market has proven you right on your winners, not your losers. So focus on your winners, not your losers. Your losers has to be black and white. It should be taking very little kind of mental energy, yet most people spend 90% of the time sweating over their small losses and trying to say, like, how do I turn the small loss back into a win?
Right.
But even if you manage to do that, that's not going to make the difference in terms of your overall portfolio. Where it's really going to make a difference is if you can turn those small winners into a home run by making adjustments, rolling those options. And that's the part that you really should be spending a lot more time focusing on if you're trying to grow your trading account.
Yeah, I absolutely love that. And aside from the terrific insight on the calendars and diagonals, for me, the biggest lesson that I think our listeners can take away from this is what you had just said. Focus less on the losers and spend more time learning how, or trying to turn those winners into home runs. Yeah, I think that's terrific.
And maybe we could just sort of wrap this up a little bit on talking about, like, when you have a diagonal trade and the trade is going in the direction. So in this example, let's say we buy that 60-day $100 call option and sell a 30-day 110 call option. What happens if the trade trades up to that 110 strike price, or even goes beyond that 110 strike price at that first expiration date? Because that's really kind of where you have a lot of different choices of what to do, right? You can choose to just let the short strike expire if it's out of the money. Let it expire and potentially sell a new call option. Maybe at that time you might want to sell a 120 call option. If the stock's traded up to 110, you basically sell another out of the money call option. You're trying to, again, collect more premium, which is going to offset the cost of the $100 call option that you've purchased. And the goal here is just to collect as much premium as possible, so that as the stock continues to move higher, you're continuously trying to lower the net break even of that long call option that you've purchased, right? That's the goal of a diagonal spread. Because if you just sold a 110 or 120 call option at the same 60-day expiration, meaning trading a debit vertical spread instead of trading the diagonal spread, ultimately you could have collected, you likely would have collected a little less premium on selling a 60-day option than selling two 30-day options, right? So that's the goal of the diagonal spread. And then if the stock really takes off, another thing that you could do is just let the short option expire and don't sell another call option, and have the unlimited upside of the long call option.
Right.
So that's what I mean in terms of, when the trade goes in your favor, it's really more of an art than a science because you have a lot of choices. And that's really where you want to spend most of your time thinking about and figuring out what is the right strategy to adjust your winners versus your losers.
Yeah, that's terrific. And an analogy that I can kind of use for that, which is appropriate for where we are here at PGA National, a lot of people spend more time on the driving range than on the putting green.
Right,
the
exactly.
practice green. You're going to take far more putts than you are drives. So I like that. Tying that back into what you had said, I think it works out really well. That's terrific.
Thank you.
Well, that's great, Tony.
I like that as well.
Yeah, well, you're welcome to use it. Really, thank you. This was terrific. I really appreciate you taking the time to sit with us. Thank you so much.
Thank you so much. This is fun. I love doing this.
Yeah, excellent.
Thank
And
you
we
for
love
having me.
having you here, and we definitely hope that we'll see you again. That we'll have you back on the show again. Always a pleasure to talk to you. That's going to do it for us today, ladies and gentlemen. Special thanks to Tony Zhang of OptionsPlay and to all of your listeners out there. I want to encourage everyone to go to our website, optionseducation.org, register for our 2 upcoming webinars that we've got. The first session is going to be calendar spreads, and then we're going to get into diagonals, so a little bit more in-depth, more so than what Tony and I had a chance to discuss today. Again, options at theocc.com is going to be our email address for any options-related questions that you might have. Tony, again, thank you so much for joining us. This was a lot of fun.
This was so much fun. Thank you so much for having me.
Yeah, you're very welcome.